This video includes coverage of Roman numeral 1 of Chapter 6. Roman numeral 1 is an introduction to audit responsibilities and objectives. And the remaining sections of Chapter 6 are in a separate recording, which is posted on YouTube for you. Unfortunately, I forgot to press the record button for Roman numeral 1, so that's why this one is separate. The remaining sections were recorded in class. So audit responsibilities and objectives, we're going to see what we are responsible for accomplishing in the audit and some audit objectives to guide us along the way. Likewise, we're going to see what management is really asserting to us when they hand us those financial statements prior to the audit and say or assert they conform to GAAP. I think Chapter 6 will be very understandable for you, and certainly if you have any questions, just let me know. So first of all, here in A, we already know that the overall objective of an external financial audit is to provide a conclusion about management's assertion that the financial statements are fairly stated in accordance with GAAP. However, to be manageable, the auditor's overall objective must be broken into some smaller objectives. And we'll study those smaller objectives here in the chapter. And likewise, management's overall assertion must be broken into some smaller assertions, as we will see. So that one big overall assertion, when they hand us the financial statements to audit, when they say that those financials are fairly stated in accordance with GAAP, we know that we're professionally skeptical. We don't fully believe that until we check up with evidence, until we gather corroborating evidence. And here in B, an excerpt in our textbook on page 143 states the overall objective of the audit. And let me just take a look at that with you here for a moment. Bear with me a moment. There we go. So it says here that the preface to the clarified AICP auditing standards indicates the following. So way back at the preface of these, so here is something that is extremely basic to us in auditing. It will sound familiar to you. The purpose of an audit is to provide financial statement users with an opinion by the auditor on whether the financial statements are presented fairly in all material respects in accordance with the applicable financial accounting framework. For us, that's normally GAAP. An auditor's opinion enhances the degree of confidence that intended users can place in the financial statements, because without that audit opinion, it would be very unwise to invest in that company. So let's come back to the handout and think about some implications of this. Well, here in B, we can note that this does not include correctness, freedom from errors or fraud, any insurance, any guarantees, etc. We never lock ourselves down with those absolute terms. Decades ago in auditing, audit reports used to, but not anymore. We give ourselves some wiggle room. So to give ourselves wiggle room, we basically attest that the financial statements are free from material departures from GAAP. And auditors only give reasonable assurance of this. Further, remember the part of reasonable assurance is gathering evidence on a test basis. So we might miss the one transaction that had a material error in it, and that happens. Auditors also approach clients with an attitude of professional skepticism, and that contrasts with being an advocate of the client as in tax practice. So we are professionally skeptical. We give no guarantee that we will find everything, only reasonable assurance about finding misstatements. So again, giving ourselves wiggle room, we never lock ourselves down. Then C, about management's responsibilities. Well, as we know, management is responsible for maintaining the financial accounting and internal control systems, policies, and procedures to permit the preparation of financial statements in accordance with GAAP. And the auditor should be able to find documentation of internal control policies and procedures in the company's policies and procedures manual. Every company should have one, It may be a lot less formal in a small company, but it's just like the college catalog is a policies and procedures manual for Florida Southern. And then second, we know the management is also responsible for the preparation of the financial statements and for disclosure, as well as for preventing and detecting fraud and illegal acts. And there's some legislative mandate for it. The Foreign Corrupt Practices Act of '77 requires an internal control system which will detect at least illegal acts for SEC companies. And the Sarbanes-Oxley Act of 2002 also mandates internal control reports for management for SEC companies. We saw one of those so-called 404 reports in Chapter 3. So there's legislative mandate. That means if a company violates any of this, their CEO and CFO could actually even go to jail because white-collar crime penalties have been very much strengthened by the Sarbanes-Oxley Act. Now, number 3, we can also see the report of management's responsibility on page 144 of our textbook. Just glance at it when you have a chance. I won't test you on it. That was optional in the past, but was a good idea for a company's annual report. However, the Sarbanes-Oxley Act now mandates the management of SEC companies at least provide written reports of their responsibility for internal control and for the financial statements. So these days, that is mandatory. Management must say, we're responsible for the financial statements. We're responsible for internal control. Now D, since the auditor's objective is to provide reasonable assurance that the financial statements conform to GAAP in all material respects, we should consider how those financials could be misstated. So let's think about some possible misstatements. The most common cause, errors. They're unintentional. They're by far the most common cause. Somebody made a mathematical error, or a posting error, or a programming error, or an error in an Excel formula, or a posting error, something like that. They happen all the time. Usually there's a pattern to them, and there's normally no intentional concealment of them. So even though we haven't gotten into audit procedures to a great degree yet, the auditor is very likely to find these, and therefore has a high degree of responsibility for finding them. Then, number 2, the client fails to follow GAAP. They take an accounting principle, they mess it up, just like financial accounting students sometimes do, or they try to institute an outdated principle, whatever it may be. They didn't follow GAAP. Again, there is normally no intentional concealment here. It was unintentional. And the auditor usually has a high degree of responsibility for finding this because the auditor is very likely to find it through normal auditing procedures. Now, what is more sinister is fraud, number 3. Also called intentional misstatements, also called irregularities. We could say cooking the books. And the SASs have increased the auditor's responsibility for the detection of material misstatements arising from fraud. Now, we always say detection of material misstatements arising from fraud. We never say for finding fraud itself, because the auditor can't find everything. Neither can a legal investigator. So we couch what we say in terms of the effects on the financial statements. I have a little note there that with embezzlement, that means stealing money. Clients are often reluctant to prosecute that if it's one of their employees. So unfortunately, that often goes unpunished. And besides, what client likes to show a loss from embezzlement in their footnotes? They don't. It's embarrassing. So let's talk about a couple of different types of fraud. One is stealing. So we could say an A, misappropriation or defalcation or embezzlement, especially if it comes to money, or stealing of assets. It's also called employee fraud because a lower level employee does have the motivation to do this. And this should be reported to management when found. And the auditor will be concerned with removing the asset from the books, recording a loss, possible disclosure. Clients don't always like doing those things, but they must in order to get a clean opinion, if material. Now, we should note there's no impact on management's ethics because even the best run and most honest client can have a lower level employee who is stealing from them. If no one else, maybe a cashier who is stealing from the cash register or some employees who are stealing inventory. It happens all the time. Now, what is worse and more sinister is fraudulent financial activity, management fraud, because higher level management does have the motivation to do this to make things look better. And that involves misstating financial records. In other words, cooking the books. It results from management override of internal control. Because we get to a high enough level, management can override internal control and take advantage of their position and do what they please. While it normally involves intentional concealment, it can involve several levels of management. So it can be concealed very, very sophisticatedly. Auditors are concerned the books are corrected and the disclosures adequate. Again, clients don't like that. Auditors also need to consider whether they can rely on management's assertions because the tone at the top may be such that we simply have a dishonest group there. Management fraud should be reported to the board of directors, and the auditor probably will withdraw from the engagement if proper action is not taken. Further, the Sarbanes-Oxley Act requires the management provide a report regarding the responsibility for internal control, and management must state their belief that internal control will prevent and detect such fraud. So management has even more motivation today to clean up the fraud, because if they say in that report that there's no fraud that they're aware of because internal control is so good, and therefore the financial statements are fairly stated, they better be able to live up to that. If there is indeed fraud and they attested otherwise, they're in big trouble. Again, they can have white-collar criminal penalties heaped upon them. I have a little note there. The management's motivation is to overstate assets and revenues and understate liabilities and expenses. That occurs in most every accounting fraud, trying to make things look better. In C, both types of fraud involve pressure and incentive to commit them and perceived opportunity to do so, as well as rationalization on the part of the perpetrator. We'll get more into that in our chapter on fraud much later down the road. But even a properly planned and performed audit may not detect material misstatements due to fraud due to concealment, because fraud often involves collusion or falsified documentation, and the need to apply professional judgment, the identification and evaluation of fraud risk factors and other conditions. And as an example of that latter, for example, a small error in cash would not ordinarily be investigated unless the auditor believes it stems from fraud. Therefore, the auditor may not investigate the error and therefore not find the fraud. Same thing for indirect effective legal acts. We'll study those in just a moment. Now in D, we know the auditor is responsible for providing reasonable assurance that the financial statements are free of material misstatements. Now that's true whether resulting from unintentional errors or fraud or illegal acts. And again, note that focus is on detecting material misstatements resulting from fraud and illegal acts. And that differs from directly detecting all cases of fraud and illegal acts per se. If there are no effects yet on the financial statements, we will not be able to detect it. Then E, the auditor must assess the risk of material misstatement due to fraud. And there are some risk factors for both types of fraud on pages 300 and 302 in Chapter 10. I won't test you on them at this juncture because we won't get to them, obviously, until we cover Chapter 10. But they're very interesting, so if you'd like to take a look at them at this juncture, that's fine. And the auditor's assessment will involve inquiring of management about their assessment of the likelihood of fraud, as well as evaluating the risk of fraud as the audit proceeds. And note the latter can change as the audit progresses because we start seeing red flags of fraud. And the auditor will follow up on all those red flags of fraud to see whether material misstatements do in fact exist. And the auditor must carefully document fraud and report to the board of directors. And a little note there that this really does help the auditor's case the auditor can say, I went through all the warning signs of fraud, all those red flags, and I followed up on everything I saw. However, I could not detect fraud because concealment and collusion on the part of top management was beyond my ability to detect it. So that's one reason the auditor is so very concerned with management's integrity, that tone at the top. And also, the higher the management level involved in fraud, the more difficult the fraud may be to detect because of more sophisticated concealment. And the potential for loss is probably higher too. Now, another way the financials could be misstated is through illegal acts, other than employee or management fraud. By the way, illegal acts are not called fraud or irregularities under auditing terminology. For example, embezzlement is against the law, but is classified as fraud under auditing terminology. So under auditing terminology, make sure that you classify an act as fraud before you classify it as an illegal act. Classify it as fraud first. And if you can classify it as fraud, remember that it's mutually exclusive from illegal acts under auditing terminology. And yes, they do test that on the CPA exam. Well, the auditor is concerned that disclosure of the illegal act is adequate. The appropriate costs, such as fines and cleanup costs, are on the books. And such items as lawsuits are properly treated in the financial statements. Again, clients don't like those things. They often omit them. That's one reason why when we deal with completeness of disclosure later in the chapter, completeness is always a problem because clients leave things out. Well, the auditor may have to consult legal counsel, but the auditor cannot inform outside parties otherwise, except that some illegal acts will have to be reported to the SEC for publicly traded companies. It used to be that we couldn't, but that list that we report has expanded over the years. So we have a little bit more whistleblowing power now. And there are two types of legal acts. First of all, direct effect of legal acts. They directly affect financial statement amounts. And indirect effect of legal acts, which do not directly affect financial statement amounts. And the auditor normally provides no assurance that he or she will detect indirect effect of legal acts. Let me show you the difference. So let's say that there is an illegal act, such as toxic dumping, that is being contemplated by top management. Obviously, that is an EPA or Environmental Protection Agency violation. So if top management is only talking about this, dumping some illegal substances to save money instead of properly disposing of them as hazardous waste, which does cost money. Well, if they're only talking about that right now, that is an indirect effect of legal act. If they have started the dumping, but it has not yet been detected by anyone, that again is an indirect effect of legal act. However, if that dumping has been detected and now there are fines and cleanup costs, etc., that has evolved into a direct effect of legal act because it directly affects financial statement amounts, and therefore the auditor would be responsible for finding it. So let's kind of sum up here in F, the auditor's responsibility. That the auditor is basically responsible for applying normal auditing procedures and for assessing the likelihood of fraud and illegal acts. He or she must also follow up whenever there are signs of fraud and illegal acts. Well, typical audit procedures include reading the board of director minutes and inquiring of the client's management legal counsel and accumulating additional evidence whenever there are signs of fraud and illegal acts. However, the auditor still provides no assurance that he or she will detect fraud and illegal acts. Again, contrast that to the responsibility for detecting material misstatements resulting from fraud and illegal acts that we discussed above. The auditor normally provides reasonable assurance here. For example, fraud and illegal acts could be concealed to the extent the auditor simply cannot detect them, as we went over. We also went over that we should remember that auditors gather evidence on a test basis. Thus, the transaction which indicated fraud or an illegal act may not have been sampled. And that stems from sampling error. It's an inherent risk of sampling rather than auditor negligence. And neither of these cases would the auditor be negligent. And in number 3, we can probably conclude that the auditor's responsibility for the detection of misstatements is from highest to lowest Unintentional errors and failure to follow GAAP. Usually we will find these through normal auditing procedures. What may be harder is employee fraud because there could be some deliberate cover-up. Harder, direct effect of legal acts, probably a level of management is involved in covering these up. So it could be harder to find. Management fraud, definitely upper levels of management may be involved, can be concealed to a very sophisticated extent. And finally, indirect effect of legal acts, there's usually no way that we can find them. And that's a general guideline. Then G. Note that if any of the above misstatements are properly treated in the financial statements, including proper disclosure, the auditor can issue a clean opinion. And to justify this, remember the auditor is concerned as to whether the financial statements are fairly stated under GAAP. And if everything is properly treated, then the financials are fairly stated. So if everything is laid out, warts and all, those financials are fairly stated, the client can get a clean opinion. It may have been a lot of work to get there. It may have been a high audit bill, but that's okay. They're still fairly stated. And now for anyone reading those financial statements, like an investor or a creditor, it is now up to them to decide whether they wish to deal with that client. After all, everything's been laid out, so it's buyer beware. Full disclosure's there, so they can make their own informed decisions. Then H, we can look for the auditor's responsibilities for the detection of fraud and illegal acts to expand in the future, and that's through a public demand. So the general public tends to think that we can find everything. By the way, as I remind you in the next video, Roman numeral 2, I'm not going to stress that, and I won't test you on it. So that concludes this video, and now you can go on to the second video for chapter 7. I'm sorry, for chapter 6. Thank you.